Market momentum is undergoing a visible shift. With inflation cooling and recent CPI data showing a steadying economy, the major indices are recovering. Both the S&P 500 and the Nasdaq have moved through recent corrections to push toward new all-time highs. This rotation is being led by some of the most conservative institutional players. For the first time since 2022, Warren Buffett has shifted his strategy to become a net buyer of stocks, moving away from his recent phase of sitting on the sidelines in cash. His specific allocation is telling. Buffett deployed roughly $10 billion into Alphabet, split between Class A and Class C shares. This massive buy-in suggests that large-scale capital is actively seeking out established value within the technology sector. This pivot indicates that institutional investors are looking past initial market volatility. They are increasingly focused on companies that possess both the cash reserves and the foundational technology required to support long-term industry growth. While much of the retail market remains focused on pure chip makers like NVIDIA, that trade has become crowded. For new investors, these valuations often reflect a high level of market saturation. There is a physical reality to this technology that often gets overlooked. A GPU cannot function in isolation. To build a productive AI data center, these chips must be integrated into a massive ecosystem of CPUs, high-speed memory, liquid cooling systems, and specialized server racks. This creates a specific choice for those looking to invest in the AI supply chain. You have to evaluate two very different business models: the companies that manufacture and sell this assembly equipment, and the companies that own and rent out the physical infrastructure. While software and models drive the headlines, the physical infrastructure represents a multi-billion-dollar layer of the economy. For the industry to scale, billions must be spent on the physical power, racks, and networking that allow AI to exist. The first group to consider is the integrators. If the chip makers provide the engine, these companies build the high-performance vehicle that makes that engine usable for a business. Dell has aggressively moved into this space. They've transformed their enterprise business to focus on optimized AI servers, recently reporting $16.1 billion in revenue from this segment as corporations rush to build their own internal systems. Hewlett-Packard Enterprise is following a similar path. Their acquisition of Juniper Networks was a strategic move to secure the networking side of the story, allowing them to sell complete end-to-end AI factories to large organizations like JP Morgan. The trade-off for this model is found in the revenue structure. Integrators benefit from massive, immediate cash inflows when a company places a multi-billion-dollar order for new hardware. As the matrix shows, that immediate cash flow comes with a specific risk. These are often one-off sales. Once a corporation completes its data center build-out, the integrator must wait for the next major hardware upgrade cycle to see that level of revenue again. Integrators offer direct exposure to the current hardware spending boom, but their long-term growth is tied to the frequency of enterprise equipment refreshes. The second option is the physical operators, such as Iris Energy. These companies don't sell equipment, they provide the essential environment, the physical land, the high-voltage power grid connections, and the industrial cooling systems. Operators like Iris Energy have a distinct head start. By repurposing existing infrastructure originally designed for Bitcoin mining, they already own the massive electrical capacity that modern AI data centers require, bypassing years of utility negotiations and construction. Their business model is essentially that of a specialized landlord. They sign recurring multi-year leases with tech giants like Microsoft, who need immediate access to power and space and are willing to pay a premium to rent it. The risk here is the sheer cost of entry. Building and maintaining these facilities is incredibly capital-intensive, and their growth is physically limited by how much land and power they can secure. Operators trade the rapid sales growth of hardware makers for the stability of recurring rent. They provide a long-term income stream, but it requires massive, ongoing physical investment. Finally, we have the cloud renters, like the Nebulous Group. They operate a GPU as a service model, acting as the middleman for computing power. They buy the servers and manage the data centers themselves. This allows smaller AI startups to rent the high-end computing power they need by the hour, rather than spending hundreds of millions to build their own facilities. Back at our matrix, the financial advantage here is scalability. Serving smaller clients allows cloud renters to achieve software-like margins. The downside is technology's pace. Because AI hardware depreciates quickly, they must continuously reinvest billions to keep their fleets from becoming obsolete. Cloud renters give you a way to capture the growth of the entire AI startup ecosystem, but you are underwriting a constant and expensive race to stay technologically relevant. Investing in this space requires moving beyond general tech stocks and choosing the specific risk profile that fits your portfolio. Let's map this. Stability. Investing direct sales. Find integrators in the lower left for hardware sales. Yield investors seeking income choose physical operators in the high-risk recurring sector. Growth investors pick cloud renters for high margins, accepting asset depreciation risk. Every AI model in the world eventually hits a physical bottleneck. It needs a rack to sit in, a network to talk to, and a power source to keep it running. The choice depends on your investment timeline. You must decide which role in this infrastructure build-out you want to own: the companies selling the hardware, the ones owning the land, or the ones renting the power.